Okay, guys, we have the FOMC decision in about an hour. I'll put a timer up. It's a little bit over an hour, but we have the FOMC decision. Hopefully you guys are ready for it. Now we got, what, an hour and 13 minutes? Now, remember, this is the dot plot update as well, so we're going to get an update on the dot plot, summary of economic projections. It's relevant. With Constantine, Pawn, Joan, BA. Good afternoon. Apple CEO Cook discussed smartphone age rules at Capitol, pushed Apple's age approach to protecting kids via punch bowl. The IMF had some news. Let me see what else we got going on. Jeff Bezos' Blue Origin has been developing tech for orbital AI data centers for over a year. And again, we got a lot of stuff to talk about today, but we got the FOMC decision. That's what we're going to be covering. That's going to be at 2 p.m. Eastern Standard Time. Markets are pretty flat, as I thought we would get today. Honestly, I'm red in most of the accounts, but they're all pretty freaking small. Look at this level, 650. It's kind of like a range level, 625, a bottom range level that you can maybe watch. See if we start pushing out of this range on the NASDAQ. If you take a look at like the SPY or something like that, SPY is at 683, almost exactly break even. Bitcoin sitting just under 92.420 at 92.416. Gold falling down a little bit, technically red on the day. Definitely top 3 FOMC decisions out there. Yeah, what should we do for a poll? What's a good poll today, guys? We already know we're probably going to cut rates 25 basis points. I mean, this is pretty likely. Yields have actually decreased since this morning. They were at 4.2% this morning. Now yields are only at 4.164% for 10-year Treasury yields. Rate odds at this Fed Watch tool are currently sitting just under 90% still, basically 90-10 split right now. 90% likelihood of a 25 basis point rate cut. We got a 10% chance of a pause, no cut. And again, markets are pretty flat. One of the things that might move markets, obviously, we've been talking a lot about Jerome Powell's tone. A lot of people think Jerome Powell is going to have a hawkish tone for this meeting. And again, I don't know what kind of tone Jerome Powell is going to have. I know a lot of people are speculating that it's going to be hawkish. I would go with more data dependent versus hawkish. I think he's going to refuse to commit to a rate cut in January. And if we look at the odds for that specifically right now, January odds for a rate cut are still pretty low. At this point, there's only about a 22% chance of another 25 basis point cut in January. Still 70% likelihood that we pause rates in January after cutting today. 7.8% odds of no cut today and no cut in January. So a little bit under 10% odds for that. It's less likely. Obviously, it's probably not going to happen. Ellen News, Powell will not cut rates to surprise everybody. I disagree. I don't think Powell really has an option today, right? We're not going to do 50 basis point cut because Powell probably doesn't want to do 25. You know, there's going to be dissenters if we do 25 that wanted a pause, right? Most likely. And so I think 50 is out the question. I don't think we're going to do 50. If we do, I'll eat my words. I just don't think we're going to do 50. It's possible we do, but it's unlikely. I think it's very possible we do 25 basis point cuts. I think if we don't cut today, they're going to get some heat for it because the labor market's weak. You know, ADP numbers have been weak and job numbers have just been low. And a lot of people are arguing, hey, it's time to start cutting. We should cut again this month. We cut the last 2 meetings in a row. We cut in October, we cut in September, and now we're probably going to cut in December as well, and then pause in January. But the question is, will we have a hawkish, dovish Powell? You know, obviously, I think we're probably cutting rates. But again, in September, Powell said a cut in October wasn't guaranteed, and then we cut in October. And then in October, he said a cut in December wasn't guaranteed, and now it's 90% likely that we're going to cut today as well. But I think he's going to follow that same tune in terms of that, and I think he's going to continue to follow that same path and say, hey, a cut in January is not guaranteed, and you know, maybe we'll cut in January. I'm not sure yet. What type of what kind of tone will Jerome Powell have today during his during the FOMC press conference? It's going to be the question. Hawkish, which a lot of people expect. Dovish, which nobody expects. And neutral / data dependent, which I expect. Again, I expect data dependence. But here is the look at the market popping up right now. There's the poll. The poll is now live. Yeah, I mean, I think market's already priced in. Yeah, we're already baked into a 25 basis point cut. I think it's the most likely outcome by a big margin, and because of that, the market's already interpreted it and got baked into, you know, the current price. And so what that means, one of the things that's always true is that when anything is incredibly likely, if we do anything outside of that incredibly likely outcome, we might have more brash, big, volatile reactions, if that makes sense, right? So if we don't cut rates 25 basis points, and that means we pause, which again, pretty unlikely, or we cut 50 basis points, which is even more unlikely, you know, yeah, market's going to move from it. I think if Powell has a dovish tone, the market might move even more, because if Powell comes out acknowledging the weakness in labor, maybe we'll have some better reactions. Crypto, you know, is going to be one of those things that wants easing, right? So a lot of people are going to be paying attention to see if we're going to kickstart quantitative easing and money printing and injecting liquidity and expanding the balance sheets, the Fed's balance sheet. I mean, a lot of people are going to pay attention to that. We ended quantitative tightening, which is a hawkish monetary policy, on the 1st, 10 days ago. So a lot of people are going to pivot to, are we going to start QE now? I think the Fed should hopefully keep the balance sheet the same size, neutral for a little while at least before jumpstarting QE. But I think we're also having to inject some liquidity because of through repos and stuff like that. And so they don't necessarily call that QE, but it's similar already. You think dovish Powell is plausible today? No. I mean, I don't think it's the most likely thing, if that's what you're asking me. I think it's more likely that he's neutral today. I think he might acknowledge the risk to the labor market to justify the 25 basis point cut we probably do today. But I don't necessarily think he's going to come out pushing a dovish scenario over the next 3 months in the next 2 meetings. You know, like, I don't necessarily think he's going to be like that. I think he's going to commit to a cut today, obviously. And he's going to acknowledge the weakness in labor, but I think he's also going to acknowledge the risks to inflation increases. And he's going to say, hey, because of the risk to inflation and blah, 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 we're basically not committing to another cut in January, is what I think. So that's going to be kind of a neutral. That's what I guess. And I think that's what's baked into the market right now. Yeah, I think if we don't cut today and the labor market continues to get weaker and weaker and weaker, and we start trending negatively in that regard, then, you know, he's going to get heat for it. He wants to end his term on a good note. He wants to seem like he's making the right decisions. He steps down in May. And so because of that, I think we're going to cut today. I think most of the market thinks we're going to cut today. Oh, his tie is almost always purple. So I'm going to go with purple tie. Question is it light purple? And I'm not the best. I'm the top 3 least knowledgeable on colors in the world right now. I don't know what light purple is called. Is it lavender? And dark purple is like mauve? Alf? I don't know how you pronounce that. Something like that. I don't know. Again, I'm not great at colors. But I'm going to go with purple because that's the high percentage chance. If he wears a red tie, markets might freak out. And honestly, speculators might freak out if he wears a red tie. Because of that, he doesn't do it. I think he picks a neutral between red and green. And I think he knows that people start talking and speculating about his tie. And so, yeah, NASDAQ's edging higher here ahead of this FOMC decision. I'm looking to see if we got any breaking news to cause this. I don't really see anything here. Hold on, let me check. I don't really see any calls for this spike up here, to be honest. Blackstone COO says, hold on. Blackstone BX COO says needing capital around chips and data centers and power is so enormous that they're really uniquely set up to go after that. Google says it's bringing Gemini 3 to Stitch. Is this Nvidia pushing? Yeah, so Nvidia rebounding a little bit here, heading up. Again, Bitcoin kind of quiet ahead of this FOMC decision. I think a lot of people are waiting for this Fed decision, and really what they say, will Powell be hawkish or dovish or neutral? Will we kickstart QE? Will we have good dot plot and summary of economic projection information and outlook? Yeah, Bitcoin's quiet. A bright red tie would cause problems. Not always. Is it mauve? How do you say this? Is it mauve? I've never actually heard anybody say the color, and so I don't know how to pronounce. I'm just gonna go with purple. Go Tigers. What's up, Steve? He's going to say good afternoon, payback, in my opinion. I might be wrong. But he might say hello, everyone, if he's doing like a speech. But generally, when he does the FOMC, it's good afternoon. He gets more serious. He's more like, he's on it. He's serious. Yeah, it's more like a navy blue almost. Again, gold, Bitcoin quiet today. Netflix down. My Netflix position is so small though. Like this is a tiny position. I don't know if I should buy more down here. I might. Okay, so again, one of the big stories for today is where do we go next year? In terms of rates, in terms of easing, what's the story there? Where do we go? I think shallow easing into next year. Neutral kind of mindset is what most people have for next year. The September summary of economic projections had the median Fed fund path at roughly 3.6% for 2025 and then 3.4% for 2026, right? So that's only a small contraction from where we're at now in terms of rates, which is neutral-ish. It's kind of like a setup for a cut now, but not really a full pivot into like commitment to easing. And then about 3.1% 2027 through 2028. Longer run rate near 3% is what they're looking for. How many cuts are penciled in for next year? So we'll see if they're going to change this, right? So again, last time they said Fed funds path was 3.6% for 2025 this year, 3.4% for 2026, and 3.1% in 2027. Longer run rate near 3% is what they're shooting for. And so we're going to see if they're going to lower that percentage. Again, this is for the federal funds rate. Don't misinterpret this as GDP. This is for the Fed funds rate, right? And so just to put this into perspective, if we take a look at this here, we're currently at 3.75 to 4%, right? And they are thinking we're going to reduce that to 3.5 to 3.75 today. And so we'll see if they lower those chances. Lower would mean more dovish scenario, more rate cuts. Obviously, if they lower the federal funds target. And you also want to look at, for the summary of economic projections, you want to look at whether the dots cluster or scatter. A wide dispersion highlights division in the Federal Reserve, right? So if it's dispersed. People are, you know, kind of undecided in that regard. There's dispersion, divided committee. If they're all close together, that means everybody basically agrees on where the path is set. Again, the last SEP showed GDP hovering around 1.6 to 1.9% in 2025 through 2027. Soft growth, not necessarily a deep recession, but soft growth. Unemployment drifting up towards the mid 4.4s, where it's currently at 4.4%. I think it's going to drift up towards the mid 4s. PCE only gradually returning to 2% by 2028, so a slow decline in PCE inflation. But yeah, if the dots stay high, it's pretty hawkish, right, on the dot plot. If it stays high, an example would be like only if one cut into next year. Markets want easing. That's a hawkish scenario, even with a cut today. If they lower the dot plots a little bit closer for next year, it means the Fed is going a little bit more into easing, bullish, I would say, for equities, bullish for Bitcoin specifically. And because of that, this is going to be an interesting story of the day. We got the dot plot update. Last one was in September. It's every other meeting for the dot plot update, right? So it's every other meeting. Last October, or the October meeting, we didn't get one of these. We're getting one today. We'll see what happens. Looking at our poll numbers, 44% think Jerome Powell is going to be hawkish today. What about the dot plot? Do you guys think they're going to lower or raise the federal funds rate projections? I mean, lower would be dovish. Higher would be hawkish. Oh, it's the last meeting of the year. It's the dot plot update. You know, I think it's important. Labor market's been weak. I think it's an important meeting. I mean, every meeting's the most important meeting. You know what I mean? In theory, I guess. He will cut. Yeah, he's going to cut today. Higher? Do you think he's going to be more hawkish? Possible. Possible. Yeah, I mean, Jerome's leaving in May. Right, May he steps down. So, yeah. Short Bitcoin, you'll have a Merry Christmas. I'm not shorting Bitcoin, brother. Dead on that. Yeah. I'm not a big shorter in the first place. Like, I would rather not short some of the healthiest assets in the world, you know? Just because of edge reasons. Like, everybody wants to do it. They want to be contrarian and look cool. Like, ooh, I shorted this and I was right. You know, but most of the time they're wrong. And so, I'm not doing it. Doesn't make sense to me. Higher. He will cut. He needs to be hawkish or inflation is going to be crazy. Yeah, I mean, Jerome Powell is generally pretty balanced. I think Powell is going to be neutral today. I think he's going to cut today, and then he's not going to commit to more cuts in January. And then I don't know what the dot plot's going to show. That's different members wanting different things. I expect the dot plot to be somewhat divided, to be honest, because of differing opinions. And, yeah, we'll see. Short your other leg? You mean my knee? I did a strength test the other day. Yesterday. Was it yesterday? No, it was the day before yesterday. Yeah. My left leg is now 96% as strong as my right leg. So it's basically back to normal. Top 3 most normal knee in the world right now, I would say. I expect Moran to say 50 basis points. Yeah, Moran's going to come out hyper dovish. He's the newest guy. He's got to prove himself to, you know, people who want easing. He's going to come in super dovish, of course. He might dissent and say, hey, I want 50. Yeah, I mean, usually the Fed is neutral. They're not going to, you know, every time we get one of these Fed decisions, you get all these people that are voting on all these outlier things, like, hey, we're going to cut rates 50 basis points, or we're going to raise rates 25 basis points. And you got to understand, the Fed is not in the business of shocking the market. You know, they're not in the business of that. They're not going to shock the market and jolt the market and make the market dump intentionally. That's just not what they're going to do. They're going to get heat if they do that. Right? They're going to go with the status quo most of the time, and markets are smart enough to interpret it correctly. And it could always come different. Like, sometimes we get something that's against the odds, but it's rare. And in most of these last Fed meetings, I've seen people vote on these outlier predictions, like, oh, 10% or whatever. And they're almost always wrong. I don't think they've been right once, to be honest. And every single meeting, I got people telling me we're going to cut 50 basis points, or we're going to raise rates. Raising rates is just completely out of the question. That's just never going to happen. Cutting 50 is never going to happen either, in my opinion. But we'll see. Again, if it does, it could cause panic. A pause could happen. And a 25 basis point cut is probably going to happen. Is what it is. First reaction's wrong. Yeah. Yeah, I think today at 25 basis, we're going to cut rates 25 basis points, and then Powell's going to be neutral in his stance. He's not going to commit to rate cuts in January. He's going to say, hey, we got inflation risks. The labor market does show some weakness, but we got inflation risks. We got a dual mandate we got to go with. And so we're not going to commit to more cuts. We'll see what happens. We're going to, again, the big story of this one, another one of the big stories specifically for this meeting, is the government shutdown. Took out a lot of the economic data. And so we're not really getting a updated recent labor report. The next labor report we get, which we're going to live stream every time we get a labor report, 8:30 Eastern Standard Time in the morning. We cover it next Tuesday, 8:30. We got retail sales. We got the new labor report coming out for November. But we haven't had a recent report to guide the Fed and what they should do. Right? So, like, we haven't had economic data to justify any decisions by the Fed that is relevant and recent, outside of private payroll numbers from ADP, which have showed weakness in labor. And the September jobs report, which showed, I think, 119,000. So kind of a strong jobs report. But again, the recent private payroll data from ADP has shown weakness. And ADP is a payroll processor, so it makes sense why their data might be a little bit more accurate, because they process payrolls. They have that data. And so I think Powell is going to cut rates 25 basis points today because we've seen weakness in labor. But he's going to use the missing reports from October and the fact that we haven't had a recent labor report or, you know, a CPI report really to say, hey, look, I'm not going to commit to more rate cuts until we get this data. And I think he's going to talk about that at least a little bit today. It's like, hey, we haven't got a report. We'll see what we get. But yeah. You think Powell will go 25-25 knowing that once he's gone, they will cut like crazy? No, I think he's going to do 25-25-25 and cut rates 25 basis points today to make it the third 25 and just refuse to commit to rate cuts moving forward. How many more meetings do we have of Powell left here? Wait, so, okay, so let me look at this. Okay, so Powell after today. After today's rate decision, we have 3 more FOMC decisions that have Powell in them. I think, wait, is he stepping out at the beginning? So May 15th of next year. So, yeah. So Powell has 3 more FOMC meetings before he steps down and he's no longer the FOMC chairman. So by June of next year, June 17th, 2026, we have an FOMC meeting. That will be the first meeting that we do not have Jerome Powell. We got probably, what, Hassett is the guy? It's probably going to be, what, Hassett? Or Waller? All right, looking at our poll, 43% are hawkish, 29% are dovish, 28% are neutral. All right, guys. We got the FOMC decision coming soon here. We got 50 minutes. 50 minutes. Again, and it's incredibly probable that Powell's going to cut rates 25 basis. Let's just be real here for a second. Incredibly likely Powell's going to cut 25 basis points. The real question is, what do we do in January? Again, Bitcoin wants easing, right? So if we get an announcement of quantitative easing today, that might boost Bitcoin. If we get lower dot plot federal funds rate projections, that might boost Bitcoin. If we get dovish Powell, that might boost Bitcoin. If we get hawkish Powell, that might push it down. And again, I'm just speculating here. This is not necessarily how it's going to go, but I think this is what most people believe and agree with, is that Bitcoin wants easing, dovish Powell is good, lower dot plot Fed funds rate projections is good. And again, if you think I'm wrong, let me know. The plus. Is it going to be live? Yes. Yes, we're going to stream it all live. 100%. We're going to stream the press conference. We're going to stream decisions in 45 minutes. So yeah, we're streaming it live. Yeah, I mean, it's an important FOMC meeting. I mean, it closes out the year and gives us the dot plot, which is every other meeting. So it's relevant, for sure. And again, looking at yields. Yields are down a little bit today. They've been dropping most of the morning. They were higher this morning, up to almost 4.2%. Now yields are coming back down there at 4.16%. Again, 4.16%. But I think what we're going to get is we're going to get a cautious 25 basis point cut today and a hawkish or neutral Powell. And then we're going to wait to see what the economic data next week shows, as well as the economic data that we get next month. And then with that data, we're going to get, it's going to change the odds of what we do in January. Right. But as of now, I think we cut 25 and Powell maintains a neutral stance on everything until we get the data come out. OpenAI, BT Milner will be the biggest IPO next year. The bigger IPO, OpenAI. My opinion. SpaceX is big and all. Question is, how do you monetize SpaceX? You know, I mean, you can say the same thing about OpenAI, but I think AI is going to monetize through data. I think this is obvious. This is really self-evident. Like, data is going to get monetized just like they do in search engines. Same way they're going to monetize data. Yeah. We go down. How many of you are coming with me? Not me. At the last Fed meeting price. Yeah, this 650 level's holding here, guys. We got 45 minutes. Starlink pays. Yeah, but who wants to buy a company that's getting subsidized by another company? You know? Ask the WNBA that question. But because of that, I don't think... I think OpenAI is going to be the larger IPO. I think... You know... I think OpenAI is obviously going to be the larger one. I think SpaceX is big, but how does it make money? You know, I think we're a long way out from the genuine business of space travel. And so... I want SpaceX so I can say my stocks go to the moon. Yeah, maybe. All right, guys. Do we go up or down from here from the FOMC meeting? Let me know. Are you bullish or bearish on this FOMC meeting? Not really talking hawkish, dovish. Not really talking what does Jerome Powell do. Are you bullish or bearish? You think we're going up or down from this meeting? Remember, I think a lot of the projected outcomes are already baked into this market. I think people already expect 25 basis points. That's already baked into price. I think people already expect hawkish / neutral Powell. That's already baked into price. Okay, I see bullish up, down, bullish, sideways, bearish. Trend is your friend. Bull, down, bull, up, bearish, neutral, bear, bullish. All right, so let me see how many bulls we got. We got 1, 2, 3, 4, 5, 6, 7, 8, 9 bulls. Bears 1, 2, 3, 4, 5, 6. All right, the bulls win. I don't know. I hope we're going up. Again, I think the dot plot's going to be relevant. Summary of economic projections is going to be relevant. What we're looking like. And again, to go back to this, the last summary of economic projections from September, because again, it skips a meeting. So we got one in September, we get one today, we skipped October. But the last one had the median Fed fund path roughly at 3.6% for this year, 3.4% for 2026, and then about 3.1% in 2027 and 2028, longer run rate near 3%. Again, so the question is, how many cuts do we get in 2026? Right, that's what people are going to be looking at for this. How many cuts do we get versus what the futures pricing in currently market closer to 3% next year. Some desks expect the Fed to stick near 3.4%. Whether we get a cluster or a scatter, like a big dispersion in the dot plot, means people are not, people are divided on what they want. A lot of groupings together means that people are in agreement mostly. The last GDP on the S&P showed it hovering around 1.6 to 1.9% this year through 2027. So soft growth, again, not necessarily a deep recession, but GDP under, averaging under 2%. Unemployment drifting higher in the mid 4s is what they thought last time in September. PCE only gradually getting back to 2% by 2028. And so for today, are they going to mark inflation down, justifying more cuts in dovish scenarios, or keep it sticking, arguing for a shallower path in a hawkish scenario next year? Will GDP and unemployment still in a soft landing territory where we don't enter a recession, which lets Powell say they're easy because risks have become more balanced, or whether they think GDP is going to get worse, unemployment's going to spike? This is what we're going to get in the dot plot in the summary of economic projections. And again, at 2 p.m. Eastern Standard Time, in about 40 minutes, we're going to break all of this down. Bitcoin is now falling down. It's at 92,280. Nasdaq falling down, Bitcoin falling down, gold is slightly red on the day, Nvidia is as well. So it's mostly a bearish day overall. No, we're gonna get cuts in May for sure. I mean, why? Because the president's picking a dovish guy, and he's gonna be a dove. He's gonna cut rates. He's gonna want easing. I mean, that's obvious. So starting in June, we're gonna get some updates regarding that. We're probably gonna cut in June, and more. The question is, what do we get up until May? Going to test and overcome 95,000. If we get a lot of easing, if we get like an announcement on quantitative easing, money printing, QE, guys, just to put this in perspective, if you want to know what QE is, I always try to explain this at least once per Federal Reserve stream. The Federal Reserve's job is to maintain balance. They can lower interest rates, and if the economy is really weak and the labor market's weak and people are struggling, they can lower interest rates. It allows everybody, including businesses, to get cheaper leverage and money, and they can expand and hire more people, and it can ultimately allow people to spend more. But one of the consequences of that can be inflation, right? Lower interest rate environment for too long can cause inflation problems, and so the Fed also they have a dual mandate. They want strong labor but low inflation, right? So if we get too much inflation, they can raise rates. By raising rates, it does the opposite. It restricts leverage It restricts liquidity, kind of pushes the economy down a little bit to slow inflation. It's not really lowering it unless we go into a deeper recession, but it slows inflation. If it's a really desperate scenario, right? Like think 2008, think 2020. There's other times we've done it as well. If it's a more desperate scenario, the Fed does something called quantitative easing, which is where they create a bunch of online money, essentially, and then they use that money to buy up bonds and other financial assets. And this injects liquidity into those markets, helps bring interest rates down faster. But it has more of a consequence with inflation, right? One of the consequences of doing quantitative easing is inflation. Bitcoin currently wants quantitative easing, and other risk on assets, might react well to quantitative easing. The reason for that is because if we get inflation, what do people hedge against inflation with? They hedge with Bitcoin, they hedge with gold, they hedge with risk-on assets when we get growth. And so because of that, Bitcoin wants easing. And we recently ended quantitative tightening on the 1st of December. Quantitative tightening is the opposite. It's not directly selling the Fed's balance sheet and reducing it by directly selling bonds, but they let their current bond holdings mature and expire basically and run off the balance sheet. It's called passive quantitative tightening is what it's called. And yeah, we ended that, which is a dovish thing. Ending a restrictive monetary policy like quantitative tightening is a dovish thing. So we did that on the 1st. A lot of people are speculating that we're now going to start kickstarting that money machine, kickstarting that money printing, quantitative easing, printing machine. But again, the risk to this is inflation, right? So is that why inflation is elevated now? Yeah, I mean, the past 5 years have been interesting. We had 2020 supply chain problems, super low interest rate environment. The Fed did quantitative easing because we had lockdowns, we had supply chain problems, we had all the stuff going on in 2020 that caused problems. The Fed stepped in and they super eased for a little while because they kind of needed to. And this caused inflation to spike along with the supply chain problems that were there to begin with because, and so prices just spiked up in that period of time. And then by 2022, prices have gone up. Inflation was like 9%. And so then the Fed steps in and they're like, hey, we got to do something about this. Let's go restrictive now. And so they raised rates like 500 basis points and then they paused them there for a year straight. And then at the end of last year, I think it was September, November, and December of last year, they did 50, 25, 25. So they cut rates basically a full percentage point for the first time in a year at the very end of last year, right? And this is what started some rate cuts. And then we started them again this year in September, and then we did one in October, and now we're in December of this year. But some of the inflation that people are feeling now is because of the last 5 years. We've had a lot of stuff go on that caused inflation problems. Yeah, tariffs earlier this year caused problems, 100%. Yeah, Director Hassett said Fed has plenty of room to cut rates. Probably will need to do some more via Fox News. So we're getting this news by Hassett. This is probably the next FOMC. This is probably the next chairman, is Hassett, right? And so if you want to know what the next chairman's doing, this is probably what the next chairman is believing here, which is that NEC Director Hassett says Fed has plenty of room to cut rates. Probably will need to do some more. And so, yeah, he's probably going to be the next guy, is Hassett. Yeah. Yeah, I don't know how many dissenters we're going to get. Last time, what did we get? We got Bowman. We got Moran on the more cut side. We got Bowman. I don't know if it was Bowman. I know it was Moran definitely dissented last time. And then in terms of on the opposing side, I don't know if we got one or not. I can't remember. Yeah, I think we got 3, 2 in terms of larger cuts and 1 in terms of a pause last meeting. I can't remember who was the dissenter on in the pauses side that wanted a pause instead of a rate cut last meeting. Nasdaq's starting to flush down here, though. We're at the bottom of the range. I kind of want to buy this here, and I might buy it. Let's see. We are seeing some red, though. This is some red. Let me make sure there's no catalyst behind this. Asset said you could definitely get to 50 basis points or even more. Fed will likely need more cuts. Stronger data could support a 50 basis point cut. Ford suppliers received China's new rare earth licenses, the company said. Again, stronger data could support a 50 basis point cut, according to Hassett. 25 basis point cut would be a small step in the right direction. Probably will need to do some more. And again, this is probably the next FOMC chairman. I'm going to buy this dip now. We'll take a little risk. Range is so choppy. We're at the very bottom of the range. We'll add one more. They're not going to add this. You don't love to see it here. Maybe some news coming out. I'll have to go check. But yeah, I got to cut this. This is a quick drop here. I mean, we're still down pretty small. We kept it at 3. 600 might bounce it, though. Man, what a fast drop ahead of the FOMC meeting. Could it be on Hassett's quotes? I mean, Hassett sounds dovish in these quotes. The market might want doves. I mean, I took 2 payouts already this week alone. All right, guys, we still got over 30 minutes left before this FOMC decision. Over 30 minutes left. Hit the like button next to the play button. Put it in 2x speed. We appreciate it. You'll get the data as soon as it drops. 2 p.m. That's a big drop all of a sudden. I'm not sure why. I gotta check. Like, Nvidia's not down too much. Apple dipped. Could be Tim Cook's comments that Pawn just posted in chat, making Apple dip. This was a strong pullback on Apple. Maybe I should have bought 600s instead. Look at the 600 hold right here. Still falling here. Now we're under 600s. Again, I'm probably just going to hands off. Not really making money today each time I try. I'm red in 3 different accounts. They're small red, but red nonetheless. So, Asset said, I'm honored to be on the list of candidates. The president will make Fed chair choice in a week or 2. I think Hassett knows he's probably that guy. And so, also, Top Step already approved both of these. Love to see it. Waiting for the funds to get sent, but love to see it. Data comes out at 2 p.m. Eastern Standard Time, specifically the summary of economic projections, as well as the rate decision. Again, the new dot plot summary of economic projections likely to show very shallow easing next year, still elevated neutral-ish funds rate, and stubborn inflation expectations. Sets up a cut now, but not a full pivot narrative. Again, the last time the summary of economic projections had the median Fed funds rate at 3.6% for this year, 3.4 for next year, 3.1 through 2027 and 28. Longer run rate near 3%. Again, we're at what? 375 to... No, 350 to 375 is what we're going to, right? Yeah, 350 to 375 is what we're probably going to do today, down to 350 to 375. 350 to 375 would be a 25 basis point cut. Powell speaks at 2:30, but we get the summary of economic projections and the dot plot information, as well as the rate cut decision at 2 p.m. Inverse head and shoulders. Yeah, again, look at Bitcoin, guys. Bitcoin at 92.25. So Bitcoin's rebounding from this drop. Dude, every single meeting, people think the market's going to crash from the Fed meeting. And sometimes it falls, but it turns into this thing where people overestimate the likelihood that it's going to go down. Everybody's always betting me that, oh, the market's going to crash. And then it drops 1% and they're like, see? And it's like, well, market might react negatively. It doesn't usually crash from the Fed meeting. Why? Because Jerome Powell is usually pretty neutral and balanced. He's not really going to commit to much. Pretending like cuts were not. Well, Powell, again, I said it once, I'll say it again. Powell in September said, hey guys, a cut in October is not guaranteed. And then we cut in October. And then in October, he said, hey guys, listen, a cut in December, not guaranteed. Now we're in December and it's 90% likely we're going to cut again. But again, I'm going to assume even if we do cut today, which I think is probably going to happen, Powell's going to say, hey guys, listen, a cut in January, not guaranteed. I think he's going to say that again. I think he's going to be neutral. I think he's going to cut 25, be neutral, stress the risks of both the labor market and inflation, and we're going to have kind of a stagflation Powell. Stagflation is not good. We'll see what inflation projections are looking like next week. We got CPI inflation. Well, again, put pump or dump in chat. You think we're going to pump or dump from this FOMC decision and meeting, press conference? Let me know. All right, guys. So looking like the pumpers are winning. This in the chat. Yeah, I'm going to show the full speech live. We're going to stream the entire thing live as it happens. We're going to stream the FOMC decision. We're going to stream the press conference at 2:30. We're going to stream the dot plot update and summarize it and break it down so you understand what's happening as soon as it happens. And look at Bitcoin back up to 92.5 thousand here. Hey, gotta get the bears out of here. I like the bears. I don't know if I've ever showed you guys this guy right here. Y'all see that? Oh, y'all can't see it, dude. I got a bear. Y'all can't see it. Oh, well. Next time, I'll show it to you. It's time. Pump it up, baby. Yeah, I mean, listen. If Powell announces quantitative easing, Bitcoin at least might rip up. If Powell, if they reduce the federal funds rate projections, markets might like it. If they lower inflation expectations, markets might like it. If Powell comes out incredibly hawkish and bearish and restrictive and saying, hey, we might not cut rates until May and I'm gone, markets are not going to like that. I think Bitcoin is not going to like that. And so those are the big question marks of today. Will they lower the dot plot federal funds rate projections? Will they announce the start of quantitative easing? What are the inflation projections in the summary of economic projections looking like? Will they cut rates 25 basis points? And then after all that stuff comes out at 2:30 when Powell starts speaking, will he be hawkish or dovish? Will he commit to a January rate cut? And more. There's a lot of stuff to question here, and those are the big questions you want to look for in this meeting. Okay. Shout out to Pawn. Pawn got me. Here, look at this. This is what Pawn just sent me. Look, this is the bear I was trying to show you, but it's not light enough in here. And you can take a look at my my ultra wide monitor right here. Look, that's the bear we're talking about. His name's Steve. Again, NEC Director Hassett, who is probably the next FOMC chairman, said there's still a lot more work we can do. Bitcoin flying up to 92.65 here, 92.65. Again, Hassett essentially said stronger data could support a 50 basis point cut. He said president to decide Fed chair the next 1 to 2 weeks, says he's honored to be on the candidate list. President will make the Fed chair in 1 or 2 weeks. Fed will probably need to do some more cuts. Fed has plenty of room to reduce rates. Powell has had a lot of negotiations to get to 25 basis points. You could definitely get to 50 or even more. A strong showcase of data could secure a 50 basis point cut. So Hassett is being dovish right now. Bitcoin is reacting well to this dovishness. Bitcoin's up to almost 93,000. It's up to 92.8K ahead of this FOMC decision. We still got 22 minutes, 23 minutes until the actual thing goes live. Again, get ready. 2 p.m. Eastern Standard Time. 2 p.m. Yeah, I think my long trade would have worked if I would have stayed in it. Again, we got a 90% chance of an FOMC decision. Or a 90% chance of a cut today. 90%. Does anybody think we're not going to cut today? Answer me in chat. Show yourselves. Do you think we're not going to cut rates today? Let me know. Will the Federal Reserve cut rates 25 basis points today? Look at Bitcoin fly up on Hassett's dovishness. 93,000 for Bitcoin right now. Look at Bitcoin right here. 93K. Yeah, I mean, if you don't think we're going to cut rates 25 basis points today, I've got some timeshares I want to sell you, okay? If you think we're going to raise rates today, I definitely do. Dovishness. Bring out the band-aids. Yeah, look at that gold. Gold's been around all-time highs for a while now. Gold's all-time highs were what, 4,400 for futures? 4,398. Gold's close. Gold could break this if we get... What would help gold? Lower interest rates? Lower dot projections, quantitative easing starting. I mean, a pause is possible. I don't think it's likely. It could happen. I'm not saying a pause isn't going to happen. I think Powell's in between a rock and a hard place. Right? I think Powell, if he doesn't cut, he looks like a jerk if we go deeper towards a recession. If he cuts 50 basis points, it looks like he's causing inflation. And so I think we're going to cut 25 today. I think we're going to cut 20. I don't think we're going to pulse, personally. Speaking of gold, gold just dumped down here. Look at this. Yeah, 25 basis points is already priced in. I was going to walk out on stage and say, I quit. F your puts, F your calls. Santa rally canceled. Depression for 3 years now. Powell says, it's my economy now. You know, nah, he's not going to do that. He wants to end on a good term. You know, he wants to end it on a good note. He's not going to. People make things political, but, you know, Powell's pretty neutral. You know, Powell only gets paid $200,000 a year to be the Fed chairman. Seems a little light to me. Like, if I had no other perks and I just made 200K a year to do it, I don't think I would. Now, I mean, Powell's, what, net worth is like 50 million. So there's obviously perks involved. But seems a little light to me. I mean, Powell made his money, just to clarify, being an investment banker, so. What kind of music is it? All right, guys. Again, 20 minutes. 20 minutes. We got the summary of economic projections, the dot plot going live in 20 minutes. Less than 20, about 18 minutes now. Bitcoin turning down here. Look at Bitcoin pull back quickly. Yeah, $2,000 a year. That's what I said. He makes $200-something a month. Yeah, Powell's going to be neutral and data dependent. I don't even think he's going to go full hawkish. Hawkish would be like, hey, inflation's too elevated. We're not going to commit to rate cuts. I think Powell's going to say labor's weak and inflation's elevated. So we're not going to commit to anything at this point in time is what I think he's going to say. I don't necessarily think he's going to go full on, hey, guys, you know, inflation's too big of a risk for us to justify more cuts. I think he's going to say, hey, I don't know. I'm going to wait for the data we get next week and the data we get in January, and then we're going to make the decision then. It's going to be data dependent. We're not going to commit to a base case scenario right now. I think he's going to repeat that a lot because during the Q&A, they're going to ask him about stuff like this, and he's just going to keep, you know, reiterating that stance. Is what, again, this is just a guess. But I think based off of the logic, it's an educated guess. I think that makes sense. He makes $200,000 a year, guys. I'm pretty sure it's something like that. I was trolling you with the $2,000 number. Chart suggests mild pullback, 20% last rally. I'm excited. I mean, I'm always excited for the Fed decisions. They're fun to watch. I'm curious about what we're going to do today. I think, you know, a lot of the time the odds are like 98, 97% for a specific scenario. This one's only 90. So there's a little bit larger of a chance that we pause today versus some of the previous meetings we covered. Still almost certain that we're going to cut rates 25 basis points today. But there's a little bit more variance, and we also get the dot plot and economic projection information. And so, you know, we got some stuff to cover. You know, we might have some movement. Yeah, it is surprising that the president and Powell have so much beef because the president appointed Powell. Yeah. Again, the next one's probably going to be Hassett. We're going to see him. We have a meeting, I think it's on June 17th. We have an FOMC decision next year, 2026 June. That's going to be the first meeting without Powell. It's probably going to be Hassett. Please tell me something about gold. Gold, for lack of a better word, is good. HD just went red on the day. NASDAQ is at 625s here. Gold's sitting at 42. Gold's been sitting around all-time highs for, what, weeks now? Bitcoin pulling back. It's at about 92.5 thousand. NASDAQ again in a very tight, choppy, sideways, neutral range here. Very tight, neutral, sideways range. Yeah, we got 15 minutes until the rate decision, guys. 15 minutes. I'm going to explain why Hassett being Fed chair will change how the others vote. Why is it assumed they're dovish on rate cuts that everyone else has to be? Yeah, no, I mean, it is a... You need everybody's agreement for a decision for sure. Yeah, silver over 60. Bitcoin back up to 92.7s now. Gold at 42.21s. What other symbol do you want me to have up? I've got gold, I've got Bitcoin, I've got the NASDAQ. I'll put the SPY up here, I think. SPY is technically red on the day. Again, we got 14 minutes left. Yeah, I'm going to stream the full thing live. Here, I'll put this up so people can see it. So again, at 2 p.m., we got the summary of economic projections, where they're going to give us the dot plot update and more. At 2:30, we're going to have the press conference. We're going to stream the entire thing live as well. And that's where we're going to get the interview from Powell. We're going to see what Powell says. But again, Fed minutes report came out a couple weeks ago. December meeting will show up right here, and we're going to cover it as soon as it drops. Again, Hassett spoke earlier. He's going to be more dovish. Yeah, I mean, we're pretty much flat on the day. Yeah, I mean, the markets are usually a little bit more apprehensive ahead of these big decisions. So markets are usually not making any big bets ahead of these decisions. We very rarely get big runs in one specific direction outside of like catalyst-driven moves ahead of the FOMC decision. Especially the dot plot one, which is a little bit more influential. All right, so we got it completely set up and ready here. Today is what? 12:10. All right, guys, here we go. Hit the live button next to the play button. Put it in 2x speed to make sure you're caught up to the stream. We appreciate it. The dot plot is basically where each member of the Fed votes on economic projections, right, in the federal funds rate targets for next year and beyond, right? So the dot plot is going to show us how many rate cuts they think we're going to get next year, what inflation and GDP is looking like next year, and more, right? And the closer the dots are together, it means the more agreement the Fed members had. The more dispersed they are, it means the more disagreement, the more different opinions they had on where things will be next year. Right, so a cluster of them together means a lot of agreement on one specific thing. Disbursement means disagreements, essentially. Yeah, so again, be ready here, chat. Yeah, so here's the old one that we're looking at. Again, looking at this. All right, looking at this. The last one had the Fed's fund path at 3.6% for this year, 3.4% for 2026, and more. So, and then 3.1% 2027, 28, longer run rate near 3%. So to watch today, watch how many cuts are penciled in for 26 versus what futures are pricing in. Market is closer to 3%. Whether we have dispersion among the dot clusters or scatter. Again, the last SEP showed GDP around 1.6 to 1.9% in 25 through 27, which is soft growth, obviously under 2%. Unemployment drifting higher to the mid-4s. PCE expectations, they think it's only gradually going to return to 2% by 2028 as of last meeting. All right, guys, we have 8 minutes left. 9 minutes, really. Yeah, gold's pretty much flat here. So people want me to talk about gold. I think gold's pretty much flat. Bitcoin coming back down. And again, Bitcoin wants easing. Nasdaq's falling down. We're at 25.6s here. The SPY is mostly flat today. Gold's slightly red on the day. And again, I think markets are just waiting for all this stuff to happen. Gold, again, all-time high in gold futures is at what? 4,400. We're at 4,200. So we're pretty close to all-time highs in gold, but we've been there for a minute now. So we got time for that. All right, guys, 8 minutes. Again, Hassett did speak earlier, did make Bitcoin go up initially when he spoke. He basically said there's plenty of room to cut rates more. Probably will need to do some more cuts. And again, he said this on X, or no, he said this on Fox News. JP Morgan says not a believer. It's a 100% deal with Hassett. We do see inflation coming down a bit, according to JP Morgan's Michelle. We do see inflation coming down a bit. On long-term treasuries, they said we were buying this morning. Everyone is expecting a 25 basis point cut. Futures expect the Fed is going to cut 25 basis points today. Yeah. So again, we're basically probably cutting rates today. I mean, I already told you guys this. 90+% odds that we're going to cut rates today. I think it makes sense that we're going to cut. I think it makes sense to cut today. And then see what the data shows next week. But I think a cut is coming. Again, 45% think Powell's going to have a hawkish tone on our stream. We got 7 minutes exactly left. Again, if you put it in 2x speed and hit the live button, you'll be mostly real time. Put it in 2x speed, hit the live button. We got 7 minutes exactly left here. Markets are choppy ahead of this report. Again, we're going to have the dot plot update, summary of economic projections update. The unemployment rate last time was 4.4% for September in the last labor report. But again, the big problem with this upcoming rate decision, upcoming rate decision is that, sorry, my wife was over here showing me food she bought me. The big problem with this upcoming rate decision is that we haven't had a labor report recently. The last one for September showed 118,000, but ADP private payroll data showed negative 32,000 jobs. I think we saw, 4,000 weekly gains this last weekly report on Tuesday this week, yesterday. So the labor reports and private payroll data, like ADP's a payroll processor, their data is usually really accurate, has shown weakness in labor, right? Not just recently, but for the last 3+ months. Now we don't actually have a payroll report from the government that came out prior to this Fed decision. So we haven't really had a labor report to guide the Fed. So because of that, I think the Fed's been watching the private data. I think that's why they're probably going to cut today. I think that's why the market expects them to cut, is because everybody can kind of recognize the weakness in labor. But again, inflation's still at 3% as well. So it's not really I don't know if it's an ultra easing scenario for the Fed. All right, guys, we got over 5 minutes left. Bullish or bearish, guys? Let me know. All gonna dump. Carol hasn't called during important times this whole year. Oh, she definitely has. But props to her, you know. All right, guys, 5 minutes. 5 minutes. Bullish scenarios baked in. Yeah, we'll see. I hope we get, bullish would be again, I think the government doing QE might make Bitcoin go up at least. I think dovish Powell would make markets go up. I think a 25 basis point cut and then a dovish / neutral tone might make markets go up. I think if we lower inflation expectations and lower federal funds rate odds in the dot plots and summary of economic projections information, I think that might make markets go up, right? But it's definitely not a sure thing. You know, I think we're going to cut rates today. I don't know what we're going to get in the dot plot updates, but again, we're going to cover it when it comes out. Commerce Department says they'll release an updated estimate of Q3 GDP on January 22nd. So we did get just get this data. All right, we're on the Federal Reserve's website here. All right, guys, we got 3 minutes left. 3 minutes. I'm sorry, I'm changing this so that we can actually catch the data here. Hold on. Okay. All right, so it's 12:10. Okay, we got that. We got this. NASDAQ testing lows here. We got 3 minutes left. You guys ready? Grab that base. Let's get the hawkish stuff going. I think there's a better chance Powell is going to be hawkish versus dovish, personally. I think there's a larger likelihood that Powell is going to be hawkish versus dovish today. Why? Because I think Powell likes to be balanced. So if we cut rates, then he's hawkish or neutral. If we raise rates, then he's dovish or neutral. I think very low probability that he's going to cut rates and have like a really dovish tone. I just think that's low odds. Low odds. Very low odds. So again, we'll see what happens. We got 2 minutes left. 2 minutes left. Hit the live button next to the play button. We're going to cover all this stuff live. We're going to cover the summary of economic projections. We're going to cover the dot plot update. We're going to cover the Federal Reserve rate decision. And so be ready. We got 2 minutes left. And then at 2:30 p.m., we got the press conference live here. Yeah, he's balanced, though. I think Powell is generally pretty balanced. He's usually a little bit balanced. He's usually not going to shock markets and be really hawkish when people don't expect him to be, or be really dovish when he's expected to. I think he's usually pretty neutral, pretty balanced. After this report, we got a lot of new data coming out. We got updated U.S. data schedule. So again, here we go. We're getting ready here. We're ready. Again, less than a minute now. Chat, less than a minute. Got about 3,000 people here. We appreciate the love. Thanks so much. Give me your last minute predictions. We got 45 seconds. Hit the live button next to the play button. Put it in 2x speed. You'll catch up to the stream. We appreciate it. Last year, we got 50, 25, 25. We got 50 September, 25 in November, 25 in December is what we got last year. This year, it's looking like 25, 25, 25, 25 in September, 25 in October, 25 in December. All right, guys, here we go. 20 seconds. Hit the live button next to the play button. Put it in 2x speed. Let's see what we get today. It's time. It's time. 15 seconds. Again, hit the live button next to the play button. Put it in 2x speed. Here's the NASDAQ. We got the SPY, gold, Bitcoin up. Let's see what we get. This timer's a little bit early. And here we go. And here is the release right now. Okay, we paused, or we cut rates 25 basis points, I mean. Available indicators suggest that the economy has been expanding at a moderate pace. Job gains have slowed this year, and the unemployment rate has edged up through September. Most recent indicators are consistent with these developments. Inflation has moved up since early in the year and remains somewhat elevated. In support of these goals, in light of the shift in balance of risk, they decided to lower the target range by a quarter percentage, 25 basis point. The committee will carefully assess and blah, 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 blah. Cut rates 25 basis points is what we did today. I told you guys we would. 25 basis point cut. Now, as for the summary of economic projections here. Let me summarize this for you right now. Again, in conjunction with the Federal Open Market meeting held on December 19th. So the new dot plot tells a slow, shallow, easing, soft landing story rather than an emergency pivot. The median dots still show the policy rate drifting down only gradually over the next few years. 26 and 27 clustered well above the pre-COVID era, and the longer run dot near roughly 3%. So the Fed is cutting, but the dots say higher for longer compared with the last cycle, and the committee is pretty split on how fast to ease. Real GDP is expected to hover around the trend, which is about 1.75% to 2% in the out years, and the unemployment rate is only edging up by the mid fours with classic soft landing territory. So they're not cutting rates because the recession just hit. They're cutting it into a still okay labor market backdrop. And the NASDAQ is flying up on this report. Again, PCE and core PCE are still shown gliding slowly back towards 2%, not collapsing down, but the path implies the Fed thinks inflation risks is moderating, but not fully conquered. So inflation is coming down in the projections, which is good. That's probably one of the reasons the market's looking up, which means that we can maybe be a little bit more dovish leading into next year is what this looks like. But yeah. And so again, slow easing into next year. The NASDAQ, gold, SPY, Bitcoin all like this report for the most part. But yeah, now they're expecting Q1 GDP for this year 1.7%. In real GDP changes 1.7%, 2.3% next year, 2%, 27, 1.9% in 2028. Yeah, so again, dot plot. SEP key lines for GDP, a headline, PCE, PV 2025. Again, the media dots still show the policy rate drifting down only gradually over the next few years. But again, they think inflation is going to get a little bit better, is I think the big story of this report. Again, votes split 9-3. Moran voted for 50. Goolsbee and Schmid voted for pause. Right, so Moran did vote for 50 basis points. Goolsbee and Schmid voted for a pause today. Again, the new dot plot says slow, shallow easing, soft landing rather than an emergency pivot. The longer run rate still near 3%, so the Fed is cutting, but the dots stay higher for longer compared with the last cycle. And remember, Jerome Powell is out of this by May of next year. Right, so by May of next year, yeah, Bitcoin coming down on this report, though. Again, in conjunction with the FOMC, the unemployment rate, inflation each from this year. Bitcoin is a dead coin. Again, we got the actual press conference at 2:30. So, you know, we got the summary of economic projections, the dot plot update as well. Here is the newest dot plot right here. The 2025, we're still pretty clustered. Showing slightly under 3.5% for one person. Most people have it clustered right here for 2026. So for next year, they're thinking slightly over 3.5% is what it looks like. You did have a big grouping here at, what would this be, like 3.8%? I would say this is like 3.6. This is at 3.8%. So most groupings are around 3.6%, which is what it kind of was last time for this year. For next year, it's kind of split between, like, most people have it between 3.2 to 3.8% up here, 3.9% from 3.2 to 3.9% in terms of where the federal funds rate is going to be. In 2027, the biggest grouping is just over 3%, and by 2028, it's the same way, biggest grouping and over 3%. And so, again, this is the federal funds rate. 25, they think we're going to be right here because this is where everybody is already. But it's pretty split down the middle in terms of 2026. 2027, they think we're going to be just over 3% by that year. And again, Bitcoin is falling here. Markets are pretty neutral in this report, though. I mean, we're not really having some crazy big reaction here to this news. We did go up, which is good. So we did go up. All right, so we got the full Jerome Powell press conference, 2:30 p.m. Eastern Standard Time. SPY is actually moving really higher. All right, so the Federal Reserve cut rates 25 basis points. mean, markets cared. They moved a little bit. But question is, what do we do now? Again, stick around. We are going to be streaming the entire press conference live. Again, Federal Reserve cut rates 25 basis points. Again, Powell said available indicators suggest that the economy. Let's actually read this again. So here's the actual statement by the Federal Reserve. Indicators suggest the economic activity has been expanding at a moderate pace. Job gains have slowed this year. Unemployment rate edged up through September. More recent indicators are consistent with these developments. Inflation has moved up since early in the year and remains somewhat elevated. They seek to achieve maximum employment at the risk of 2% over the long run. Uncertainty about economic outlook remains elevated. They're attentive to these risks on both sides of the dual mandate and judge that downside risk to the employment rose in recent months. In support of these goals, in light of the shift in balance of risk, they decided to lower rate 25 basis points. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. So, some people might think that's QE. It sounds like they're going to keep the balance sheet the same size, is what it looks like to me. Hawkish cut. Yeah, I don't know if it's hawkish. Nasdaq's still spiking, though, here. Look at this move. The Nasdaq is still pumping up some on this. Look at this move. Yeah, I don't think the Fed's doing QE. I think they're just going to keep their balance sheet the same size. Again, vote and policy of favor decision was 9-3. Moran, 50 basis point cut is what he wanted. Goolsbee and Schmid, no cut or a pause. Federal Reserve is apparently going to buy $40 billion worth of Treasury bills over the next 30 days. Again, if we take a look at, again, Fed cut rates by 25 basis points. They will consider the extent and timing of additional adjustments. They will begin purchasing Treasury bills on December 12th. They'll buy 40 billion Treasury bills in 30 days. Again, Schmid and Goolsbee dissent. The PCE inflation now seen at 2.4% versus 2.6% prior. Core at 2.5 versus 2.6%. They expect GDP growth 2.3% up from 1.8. Long run growth unchanged. So again, I think this is a dovish scenario, and I think that's why markets are reacting well to this. I think we got lower inflation odds. We've got better GDP data, which could argue against the cut. But we've got the Federal Reserve acknowledging weakness in labor, as well as they're going to start buying up Treasury bills. Now, I don't know if this is necessarily, they might be keeping it the same size, but yeah, I think it's good if you want easing, is what it looks like to me. Let me see yields, how yields are responding to this. Yeah, yields are down slightly on this report. If we look at yields, remember, yields and interest rate sentiment, you know, yields follow interest rate sentiment. So if we go lower in yields, that means lower interest rate sentiment. And yeah, yields are down in anticipation of this, but I do think it was already kind of baked into this. I'm curious what the odds of yeah, the Fed watch tool is down. Okay, there it goes. No, it's down still. I'm curious what January is showing now. So January is still at 70.3%. This is not really going to change yet. Here's January. And again, we're going to stream the entire press conference live, 2:30 p.m. Eastern Standard Time. Yeah, Fed says they're watching both sides of their mandate. It says downside employment risks have increased. Again, Federal Reserve is going to buy 40 billion in Treasury bills over the next 30 days. I think they said they're going to start December 12th, which is 2 days from now. AI has gotten all the major investments. It's going to get to the end of next year. Yeah, so the headline is Reserve Management T-bill buying, not QE. There we go. NASDAQ, most markets are reacting well to this, though. And again, I think it's a good scenario for doves. Not classic QE. The market might treat it as such, though. I think I like my current poll. Yeah, I'm kind of looking at some of this other stuff here, but again, in good news, like, look, some of the best thing is that the Fed's end of 2026 PCE inflation projections went down to 2.4 versus prior of 2.6%, core at 2.5% versus a prior of 2.6%. So they see inflation decreasing. They expect GDP growth 2.3 up from 1.8%. So again, gold, if you look at it, is positive on this report with equities and the NASDAQ and Bitcoin. Buy up. Again, the projections, though, show a wide divergence of views for path of rates in 26 and beyond. They see end of 2026 2.4. Economy growing at a moderate pace, job gains slowing, and unemployment edging up. I'm surprised they didn't mention inflation, though, and I think it's a win that they didn't mention inflation. Yeah, here, I'll put a timer up. Again, we got the actual press conference going live. I'll put the stream up here. Hold on, we got, what, 17 minutes? Yeah, this is when the press conference starts. We'll stream it live. You guys ready? Will Powell have a hawkish or dovish tone? We did a poll already on this. Will Powell have a hawkish or dovish tone? 16 minutes. Hawkish or dovish tone for Powell? Dovish, neutral to dovish, hawk. I don't think he's going to be dovish. I think that's optimistic. I think Powell is probably going to be neutral. I think Powell's going to be data dependent and neutral. I don't think he's going to really be super, I think he's going to be data dependent, neutral. I would love for him to be dovish. I think dovish would make the market react well, but I just don't think he's going to be. So I don't think Powell's going to be dovish. I think he's going to be neutral. He's going to say, hey, guys, like, inflation is getting a little bit better in the projections. Labor market's still weak, but because we're still at 3% inflation, we haven't gotten any labor reports or economic reports since September's. We're going to be data dependent right now. I think that's what he's going to say. I think he's going to refuse to give a base case. I think there's too many there's too much... it's too spread out in terms of the dot plot. And so because of that, I think he is not going to be super polarized. He's going to choose to be neutral and data dependent is what I think. And I think if you look at the poll, I asked people this earlier. I'm surprised neutral data dependent didn't get more votes, but 46% think he's going to be hawkish. I think a hawkish Powell might reverse some of this action that we're seeing right now. I think if Powell comes out hawkish, markets might pivot back down. We might reverse back down here if Powell is... yeah. I think if Powell is hawkish, I think markets are going to turn. Is what I think. And so again, 14 minutes until the rate decision. 14 minutes. Again, Federal Reserve cut interest rates. Again, inflation, PCE inflation expectations did go down, and that's a good thing. That's a good thing. The Fed looks at PCE inflation. We had PCE inflation, what, last Friday come out? It was pretty much flat. Again, 2.4% last time was 2.6, so lowering of inflation expectations is good. Again, they said the economy is growing at a moderate pace, job gains are slowing, and unemployment is edging higher. It sounds like they could be dovish if they wanted to. I don't necessarily think he's going to be, but I think we could if he wanted to. What color will Powell's tie be today, guys? We did break 168,000 subscribers, so thanks so much, chat. I appreciate the love. Thanks so much. Dovish, red tie, blue tie, never. Lavender, yeah, I think lavender. Mauve is what I'm going to go with. I'm going to go with mauve. I just looked up how to say it. And so that's what I'm going to go with. I'm going to go with a mauve tie. Apparently, I've been saying mauve, which sounds, I think, a little bit more like snooty. But apparently, it's mauve. Never heard somebody say it. I just say purple, guys. I say dark purple if I need to. But I'm going to go with mauve. No tie would be crazy. That's never happening. He's going to wear a tie. Christmas tree? I would love it. He should. The conference, I'm not sure. It's probably, what, like an hour? Powell speaks, and then they do a Q&A, and Nick Temeros gets a question, and, you know, the bald guy from banking, I can't remember his name, but they all get to ask Powell questions. Again, Meta, Apple, Microsoft, Google, and OpenAI are among 3 companies that received a warning letter about chatbots. Again, Fed cut 25 basis points as expected. The votes was split 9-3. Moran voted for 50. Goolsby and Schmid voted unchanged. Glitter? Ah. I don't think Powell would ever come out with a glitter tie. Michael Burry might, but I don't know about Powell. All right, NASDAQ pulling back down here. Again, press conference starts in 11 minutes. 11 minutes. One voted for 50, or no, yeah, one voted for 50, which is the newest Fed member, right? He's got to prove himself. So he's like, hey, I'm dissenting. I'm going to vote for 50 basis point cut. And then Schmidt and Goolsby voted for a pause. It was 9-3. So 9 people wanted 25 basis point cut, which is what we got. They were the majority. 3 voted for something different. One of them was Moran. He wanted 50 basis point cut. Goolsby and Schmid voted unchanged. Moran's the newest one. So he's going to be dovish for sure. Yeah. Again, here's the dot plot. You want to see... Pretty spread out, dude. Look at how spread out this is. Like, right, like, just to put this into perspective, for 27, we got a little bit more consolidation. But a spread out dot plot means a lot of, like, differing opinions in terms of where the rate should go into next year. Right? Like, the more thin this is, the more spread out, because it means, like, there's multiple different... Like, this is grouping, obviously, but this is what we got today, right? So this one was widely agreed on. It starts to get a little bit more consolidated into 27 and 28, but next year there's a lot of question marks. Basically, people are really spread out on the dot plot. There's a lot of disagreements in terms of where the federal funds rate should go in this period of time for next year. It's mostly spread between 3 potential ranges. One of them slightly over 3% into next year, which is a lot of cuts. One is right at 4 in the middle at around, what, 3.4%. 4 more hawkish at 3.6 or 3.7%, and then 3 are even more hawkish at like 3.9%. Right, just to show you guys the dot plot and like where it is. That's what it looks like right now. Yeah, who is John, dude? What a name, though. Sounds like a great guy. I've heard he's a genius too, you know. He types really quickly as well. You know, he's devastatingly attractive. That's what I heard. But who is John? I don't know who that is. NASDAQ at 25.7s here. You heard wrong? Yeah, I probably did. That's true. Top 3 worst sources ever on my end right now, I guess. Number 1 tulips futures trader. Definitely not number 1. I would say I'm like the number 3 tulips trader out there right now. When it comes to tulip trading, I know my stuff. Okay. All right, guys. Hey, we got 7 minutes left. 7 minutes. All right, guys. 7 minutes. Again, hawkish or dovish tone here. I'm going neutral. Neutral's the smart bet, I think, in my opinion, right? I think if you have to look at what kind of tone Jerome Powell is going to have during this press conference, super hawkish doesn't really make sense considering he said there's weakness in the labor market. Super dovish doesn't really make sense because we haven't had any economic data to come out prior to this meeting. And so I think the only thing that makes sense is a neutral Powell that says, hey, we're not going to commit to rate cuts in January. I don't know basically what we're going to do. We got to wait and see what the data shows. Data-dependent neutral Powell, I think, is what we're going to get today. I think that makes the most logical sense. I think we haven't had any economic data to guide the Fed into next year. We get some next week. We get PCE, or no, we get CPI next week. We also get the November labor report on Tuesday next week. We get retail sales, more stuff to guide the Fed next week. Because of that, I think Powell's going to cut 25 today, which I said before he cut. And he's going to be neutral in his speech. If he's hawkish, I think the market's going to react negatively to it. If he's dovish, I think obviously the market's going to react positively to it. Especially like Bitcoin and stuff like that. But again, let me know what you guys think. We're heading closer. John, call Jerome Powell, tell him we want a Santa rally. I mean, you want me to bully Powell into being the super easer? I don't know, man. I don't know. Our January rate cut odds? Yeah, January rate cut odds are right here. Prior to this meeting, let me see if I can refresh it. Yeah, I mean, January rate cut odds are currently 24% likelihood. This is January 25 basis point cut. We're currently at 350 to 375 after today. This would be another 25 basis point cut in January. It's currently 24%. And again, I think that makes sense considering Powell's not going to commit to rates. But I do think it's still early and these odds are subject to change. And listen, I appreciate the donation. Thoughtful project. Talk to me about 10-year yields. I appreciate the donation. We got less than 5 minutes before the press conference, brother. I appreciate it. Again, yields have mostly been flat. I think most of this outcome is baked in. Yields are actually spiking up a little bit on potentially more hawkish outlook for next year. But again, personally, I think we're going to have neutral Powell today. Again, we got less than 5 minutes. But I appreciate the donation. Thanks so much. How many times is Powell going to clear his throat? Listen, bro, water's transitory, okay? Imagine Powell steps down. Powell's not stepping down, man. People told me Powell was going to step down during, what was it? During his dedication speech that was during the blackout period. And I told him that wasn't going to happen. Everybody always betting on Powell to step out. Why would he step down 4 months before his term ends? It's not good optics. It wouldn't make any sense. He's going to finish his term. All right, we got 3 minutes left. 3 minutes. Again, here's the New York Fed statement regarding reserve management purchases operations. It's the buying of T-bills. Again, Fed cut rates 25 basis points. We'll consider extent and timing of additional adjustments. We'll begin purchasing Treasury bills on December 12th. They'll buy 40 billion of Treasury bills in 30 days. Schmidt and Goolsbee dissent in favor of no change. Moran wanted a 50 basis point cut. And again, they signal rate cuts might be done for now. All right, guys, here we go. 3 minutes here, 3 minutes. Thank you for the donation, though, guy. Helpful guy. Yeah, thank you. The dono. I appreciate it. See what we get today. Sorry. Also, I pride myself on having the top 3 loudest FOMC streams, and so when Powell starts to speak, we're going to turn the volume up. I'm also going to mute the music now because we have 2 minutes left. Here, 2 minutes left. And again, if for whatever reason the volume is not to your liking, just let me know. Again, hawkish or dovish Powell. I'm going to go with neutral. We could be hawkish. They could be done cutting rates. At the very least, though, we're getting most likely Hassett in May, and so we might get a little bit more dovishness. I can speak louder, but can Powell? Chicken hawk. All right, guys, here we go. We got a minute left. 1 minute left. Let's see what we get here. Good. 1 minute left. We got 2 different streams on here. I'm going to turn the music off. And it's time. It's time. Let me turn the volume up too so y'all can hear it really well. Yeah, just let me know if it doesn't work. 0. We got multiple speeches up. Again, hit the live button next to the play button. Put it in 2x speed so you can catch up. When the stream does start, let me know if it's not loud enough. I can always turn it up. I think usually this one is a little bit better, so I might actually pivot this one here and move myself out the way here. Usually a little bit better option. Stretch this. Oh, okay. All right, guys. Waiting on him. Here we go. Where's his tie?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Thank you.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set, but you are right about those 3 cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months, goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Like,
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now, it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. You know, it's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
You know, it's not so stark as that. The views are more varied on in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record. Yeah,
so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low low-rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's, I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Okay, guys, so that is Jerome Powell today. Bitcoin's starting to fall back down here. Let me exit out of some of this stuff. Look at the NASDAQ. NASDAQ is loving this FOMC decision. Again, I would say it's pretty neutral, Powell. He's not committing to January. Look at Bitcoin dump down here. Whoa. I would say it's pretty neutral, Powell. Again, look, I'm not one to brag, okay? I would never brag. All I'm saying is that we did do 25, 25, 25, and Jerome Powell was pretty neutral during this report. I hope you guys understand, like, if you're betting on some type of really contrarian idea ahead of these reports, you're probably wrong. Most of the time, Jerome Powell's not going to shock markets. The market's pretty smart. I mean, obviously, I'm not talking about everybody, but the market can generally price things in fairly decently. Look at Bitcoin start to fall. So fairly decently, markets can price things in. SPY is all the way up to 688 right now. NASDAQ up to 25,840s. Gold spiking up on this report. Again, Jerome Powell, I would say pretty neutral. Acknowledge the risk to inflation and the labor market. They need to let me go out there and ask questions, because some of the stuff I was explaining to you earlier, like, people, look, inflation is a risk. Obviously is a risk. But the real reason people are unhappy now is because of the last 5 years. We got super easing 2020, quantitative easing, rates at almost zero, trying to save the economy from what was going on at the time. Because of all this stuff, by 2022, which is exactly the date Powell said, inflation spiked up to like 9%. I was sitting here on YouTube doing the same thing. So I experienced this. Rates went up to, inflation went up to like 9%. Then the Fed goes hawkish. They raise rates 500 basis points. They pause them at those restrictive levels for a year. And then at the end of last year, we started cutting rates again. Then came the tariffs and all this stuff. And then now we cut rates 25, 25, 25 this year. But most of the people are still unhappy about the price increases that we saw 3-4 years ago versus like the current rate of inflation. 3% is not necessarily good, but it's not like the worst it could ever be as well. Again, in 2022, we saw 9-point-something% inflation. The 80s were even worse. So Are we in a good spot with inflation? Not really, but we're also not seeing like a crazy high inflation rate currently. You know, once prices go up, you're kind of stuck with them unless we enter like a deep recession or depression. Inflation rarely goes down, it slows down. And so you got to have reasonable expectations for it. And I think, you know, one of the questions that was asked is, why are we seeing private weakness in labor? Like the private data that we're seeing shows a lot of weakness versus the government official data. One of the main reasons is because the private data comes from ADP. It's a payment processor. It has a lot of this data. It definitely, at least in the last couple months, has shown more accurate data for the last 6 months, I'll say, because it probably has more accurate data because it's a payroll processor, right? Like that's why the ADP private data is generally a little bit more accurate. And when we look at the ADP data, it's weak, right? It's negative, 32,000 last Wednesday. This last Tuesday, yesterday, it was like only 4,000 jobs gained, or like 4,750 or something like that. I can't remember exactly the number it was yesterday, but it's been showing weak numbers. It showed negative 2,500. It showed negative 32,000. It showed negative jobs gained on average per month. And so it showed weakness for sure, right? And the Fed understands this stuff. Like at a certain point, the labor market has to be a priority, because if not, and we enter a recession, markets react negatively to that. Even if we do start super easing from that, it's still too late, and markets will react negatively to it. We'll have to super ease, which will make inflation worse anyway. And so at a certain point, the labor market has to become the priority. And again, I agree with that. It's why I said I think we should cut rates 25 basis points this month. It's why I told you guys I thought we'd do 25, 25, 25, which is what we did. And again, as for January, they're going to wait for next Tuesday's NFP report. They're going to digest that. They're going to wait for next Thursday's CPI report. We haven't really had a lot of data come out. And so they're not really going to commit to anything until then. And because of that, we got a pretty neutral Jerome Powell. But I think a 25 basis point cut, lowered projections for the federal funds rate and inflation in the SEP, as well as a neutral Powell and a 25 basis point cut. I think that's a good thing. I think that's why markets are reacting well to this. It makes sense, in my opinion. It makes sense. No, I'm not staying on for Oracle. No. So yeah, I mean, that's what it is. Again, guys, listen, you want to help support the channel, subscribe. I appreciate the subs. We did break 128,000 subscribers. Thanks so much for that. We did break 128K. No, you know what's lighting up my stream right now? I've got a 49-inch ultra wide monitor that you guys see right here. It's bright. I probably need to wear some glasses when using this thing. Top 3 brightest monitor ever right now. I don't even need a light. I used to have a light that I plugged in. I don't even need it anymore. But again, you want to help support the channel, check out Top Step. If you want to learn to day trade, most day traders lose money. Doesn't matter what course you take, who you follow, who your mentor is. In your first couple accounts, let's be honest here, you're probably about to lose that money. Okay, that's what most day traders lose. This is objectively true if you look at the statistics. And so why fund your own account thousands of dollars trying to look cool in markets, right? Instead, try Top Steps, $50 a month for the base one. You learn how to trade this way. It's like a souped up demo account. You pass the test. They give you a test. You got to make 3K without losing 2K. You pass it. They fund you 50K, 90% split, which is similar to funding your own account. You fail it, you lose $50. Not the end of the world. It's the best of both worlds. They pay out millions, fund thousands, just genuinely useful for learning how to trade specifically. They recently lowered their activation fees and more good stuff. I'll put the link up. Great way to help support the channel. There's the link right there. I'll put it to the top of the chat. They are a sponsor of mine. I am biased. I get paid by them. I don't even claim to be a good trader or economist. Top 3 worst economists ever right now. Although I was right about this meeting, right about the path 25 months ago, and right about Jerome Powell's tone. Top 3 worst ever, guys. Again, as soon as I close this stream, it's going to immediately bring you guys to tomorrow's stream. Tomorrow we got jobless claims on unemployment filings. If you want to talk about labor, the reason jobless claims every Thursday is relevant is because it's a more real-time look at unemployment. A lot of these labor reports are delayed, or they're for a month ago, 2 months ago, whatever. Jobless claims is a week-to-week report. And so lower claims means less people filing for unemployment. It's not perfect data. It's how many people are filing for unemployment, and there's some more nuance there that might make it different from payrolls. But it's relevant, and it's real-time, and it drops tomorrow, 8:30 Eastern Standard Time, live right here. Again, some of these links, Top Steps is a sponsor of mine. I'm biased. And, yeah. I got the tie wrong. I did get the tie wrong this time. Listen, I thought it would be a dark tie. I just learned how to say it. Mauve is what I went with the tie this time. Definitely got it wrong. It was more of a lavenderish light purple. And I feel bad about it. I really do. I genuinely feel bad. I dropped the ball there, and I'm sorry, guys. You know, because of that, I just want to apologize to you guys. I should have been right. I should have known. You know. I should have known. I'm sorry. Listen, as soon as I close the stream, it's going to bring you to tomorrow's jobless claim stream. It's all love here, guys. It's all love. I expect you guys to wait there until tomorrow. No bathroom breaks. No music. Just focus. All right, I'll see you guys then. Y'all be good. Have a great day. Again, just joking. For liability reasons, don't actually do that. But I'll see you guys tomorrow. Y'all be good. Have a great day. Let me make sure. All right, guys. Oh, it didn't. I almost didn't do it. I almost missed it. I would have gone nowhere. All right. Jobless claims unemployment. I'll see you guys later. Y'all be good.